The stock market continues to hit record levels. It drops a minuscule amount for a day or two and then jumps back up to new highs. There can't be any further discussion about whether or not the central bankers are aiding in this rise. It's all very clear now. But the question is really why any of this is justified, considering that the actual real economy itself is looking terrible and it's persistent. We saw true weakness in 2018, it went all the way through 2019, and now in 2020 it hasn't let up. But will there be a moment in which the stock market realizes how terrible this really is? Or will the stock market continue to defy gravity? You came here for the truth, so let me unveil that for you. Today we're going to look at what's going on with global shipping. I'm going to give you all the details surrounding that. I'm going to talk about the report that MIT has talking about the recession possibilities now at 70%, as you can see from the title, obviously. I'm going to look at several economic indicators. I've got a lot of information surrounding the financial system. There's a lot to cover, not a lot of time, so let's begin right away. Shipping Bellwether hits an all-time low. The chart you are looking at is called the Baltic Cape Size Index, and this right here is different than the Baltic Dry Index, which I will also show you, but just wanted to give you more insight as to what this is and what has been happening. You could see that it has moved into the negative right now. It is a volatile indicator, all right? I just wanted to show you this line right here represents 5,000, and it is now in the negative. That was just a few months ago. So in a short period of time, it can really move up or down. This chart gives us the information from 2015 up until the present, and you could see it's been jumping all over the place. But right now, today, along with all of that other information I've been showing you, you could see right here that it has moved definitely along with so many others right down to the ground. Index tracking freight rates for the world's largest cargo ships plunges deep into negative territory. All right, so we're looking at that. There's an article that goes along with that in the Wall Street Journal. A bellwether of the global shipping market has hit an all-time low. Commodities, as they stay right here in the second paragraph, their prices went to multi-month lows in recent days. That has added pressure to shipping freight rates, the price at which cargo is delivered from one point to another, for the world's largest raw materials ships known as Cape-size vessels. That's what we're looking at with this one in particular, and obviously this is so important. The Baltic Exchange's Cape Size Index, which constitutes part of the Baltic Dry Index, an important proxy for the world shipping market, extended deeper into the negative territory after slipping below zero for the first time ever. Understand that yes, it is volatile. It moves up, it moves down. But for the first time ever, this is worse than what we saw during the financial crisis. It's worse than what we saw 2015, 2016. It's important to follow all of this information and not just look at this one thing. That's what people do. They point to it and they say, well, because of this issue or that issue, you shouldn't be focusing on it. It's wrong, it's incorrect, or whatever. This is just one of hundreds and hundreds of indicators. Cape-sized vessels move products such as iron ore and coal from mines in Latin America and Australia to Europe and China. I like to really look at a lot of this data and bring you as much as I possibly can. This is the Baltic Dry Index. You could see it just continues to fall further and further, currently sitting at 415 at the time of this recording. It was lower back in 2016 around that time frame, and this is not a record low for the Baltic Dry Index, but you can see the same basic movement. It had been much higher just a few months ago, and it has come down ever since. It really got high back, in the commodities boom and everything that was happening around the financial crisis time frame leading up into it, but you can see that over the last 10 years, it has been on average getting slower and slower, contracting further and further. About 80% of the world's goods trade by volume is carried by sea, and China is home to 7 of the world's 10 busiest container ports. I don't think a lot of people actually have an understanding of how looking at this data is so integral. When you see what's coming in and out, you're going to be able to gauge something way before it actually happens. Just like if they're going to do something with interest rates, it's not necessarily going to impact markets immediately. it might take time. So we need to be ahead of it, like chess. You're not playing the next move, you're playing 3 and 4 and 5 moves down the line. A closure of the world's manufacturing hub impacts container shipping at large and is a vital facilitator of the intra-Asian and global supply chains. This will affect many industries and limit demand for containerized goods transport. Everything from cars and machinery to apparel and other consumer staples are shipped in containers, and disruption to the industry could reverberate far beyond China as the country deals with its issues. So this right here just gives you some insight on why this is important, why I consistently bring it up, and why we should be looking at alternative data more so than what you tend to see with the PE ratios and all that nonsense. So MIT had produced this report here, and I wanted to show it to you. It's a very unusual way of looking at things, and I like to give you as much alternative data as possible. As I always say, with any indicator, with any index, any of this, you got to take it with a grain of salt. You simply take it in and say to yourself, well, okay, good to know, but you're not going to just overreact to it. You're not going to say, this is the be all end all or whatever. When I look at something like this, I just take it in and I add it to the pile. The authors introduce a new index of the business cycle that uses the, and I'll try to pronounce this correctly, Mahalanobis distance to measure the statistical similarity of the current economic conditions to past episodes of recession and robust growth. Now, the reason I'm mentioning this, by the way, before I continue on, is that when you look at this index, it's actually pretty smart the way that they do so. They actually get into the details here. Let me read it. Their index has several important features that distinguish it from the Conference Board's leading, coincident, and lagging indicators, those ones I've shown you many times before. It is efficient because as a single index, it conveys reliable information about the path of the business cycle. Their index gives an independent assessment of the state of the economy because it is constructed from variables that are different than those used by the NBER to identify recessions. You know, the NBER, the group that was 1 year late on identifying the recession, the financial crisis, that's what they're referring to there. It is strictly data driven, hence it is unaffected by human bias or persuasion. It gives an objective assessment of the business cycle because it is expressed in units of statistical likelihood, and it is explicitly accounts for the interaction along with the level of the economic variables from which it is constructed. I know that was a lot, but I just wanted to explain it before I show it to you. This just gives you an idea of some of the data that it's built upon. We construct our index using the following economic variables starting from 1916 and it ends in November 2019. All right, we're looking at industrial production, non-farm payrolls, return of the stock market, that's the 1 year return measured monthly, and the slope of the yield curve. You know, they're going to go into more details in here. I don't want to bore you anymore, but using all of this data and explained in the way that I did previously, to me, this is actually a pretty robust indicator, an index, but it's just one of many. And this right here shows you right now at this time, well, I guess that would be as of November 2019's data. This just gives you an idea. 70%. That's where they're at right now. 70% chance of a recession going on right now. It seems to be pretty accurate when you look at it in the previous instances. We've seen many types of indicators like this regardless, but at this time, they are suggesting a 70% chance of recession. I don't think it really gives us time or factors that are involved in that, but it's just a percentage. It's just something to note. I don't want to harp on this too much, but I'll leave it with you and you can decide what you want to, really glean from this. I just think it's important to look at data like this and understand that when we have some of these more robust type indicators, we should be looking at it. This was brought to me by a subscriber. Liabilities and capital, liabilities, deposits with the Federal Reserve banks other than the reserve balances. I want to actually get you some more data on this. I want to track and trace the money, as they say, follow the money. I want to see where this is going to and from. I want to give you some more detail. But at this time, all I have is this chart. Right now, it seems to be basically at a record high, $400 billion, $413 billion to be precise. And I just think it's interesting because what we're hearing a lot with the Federal Reserve and with the repo operations, they're always talking about the reserves. They're always talking about what the commercial banks are doing, the reserve requirements, and so on. I just thought it was interesting that this has been accelerating over the last few years, and you can definitely see that here on this chart. I want to bring you some more data, but I'm going to leave it at that for now. According to Goldman Sachs, what's happening right now, the situation going on that I can't mention, this is apparently going to have a baseline drag of nearly 2 percentage points on global growth in the first quarter of 2020. We'll see what actually happens. It could be a lot worse, and that could in fact drag into the second quarter, though they don't say that. They say everything's going to be fine by the second quarter. I don't know about that, but we'll see. That's Goldman Sachs and what they believe. Corporate tax cuts will produce massive new economic growth. Northman Trader says, well, we're still waiting. This just shows you on the chart here, federal government current tax receipts that have been declining over the last few years, and then GDP, which has pretty much been flat for the last few years. And that's not a good thing, of course, because we have been pumping more money in. There's more stimulus coming from all directions, and yet they still can't make this happen. And that's just the way it works. You have to pump more in to get the same results. How crazy is that, the way it works? Just like you have with an alcoholic or something else, they need more to get the buzz. It's just how it happens to be, and they just will eventually have to come around to that. As you can see with QE4, they really accelerated it this time around in response to what had been happening in the markets, and it has been working very well for the stock market, but not for the economy, because printing up money out of thin air and moving money around in debt and all this garbage doesn't actually fix any problems, doesn't actually boost anything except the pockets or the wallets of those who are interconnected with all of it. Not you and I, that's for sure. University of Michigan consumer sentiment, that's the blue line. This has been rising since the financial crisis. And then you look at the unemployment rate. All right, and I've pulled out the highlighter right here, and you can see the blue line has been going up further and further and further, whereas the unemployment rate has been going down. You know what's been going on with that. Currently sitting at, I think it's 3.5 or 3.6%. That is historically extremely low. However, when you look at it in the previous cycles, all right, this chart goes back to the 80s basically up until present day. Doesn't it look interesting to you that they always seem to have this mass divergence in between the two? When you look at it, we see the unemployment rate, for instance, going down every single time, and then suddenly it turns around on a dime. This happens to be the case every single time, of course. And then we tend to have this as well, as you can see, particularly throughout the 90s, where the consumer sentiment is so high, everything's fantastic. Things really changed though if you look at this in this time frame here, because of the housing crisis and the subprime crisis and everything that was interconnected with that. But definitely you can see what's going on, particularly with the unemployment rate and what that teaches us. Morgan Stanley's US equity risk indicator. This just gives you an idea of the exuberance that we are seeing today. It is quite the opposite of what we had back in 2019, where there was so much fear, everybody's getting scared there, but that didn't last very long, of course, because they instituted the rate cuts and then they brought in QE4, and things have really changed ever since. Looking at the value of the global negative yielding debt, this has been moving around a lot. It peaked out approximately 17 trillion, just shy of 17 trillion if I'm not mistaken, right here at this point, not that long ago it seems, and it had moved down to around 11 trillion or so, just a little bit above that, currently sitting at $12.67 trillion worth of negative yielding debt. What does that tell you about the current state of the financial system, about what they have been doing, the manipulation, and why you have been seeing so many out there suggesting we have to go and change our portfolio structure from a 60-40 split to a 75-25, and as if there's no other assets out there. It's just bonds and stocks, and that's all you can get. Don't worry about it, but that's a whole different thing altogether, not the topic of this video. I'm just suggesting to you that we have really entered a completely different territory today, and things are looking a bit messed up. I just wanted to mention this very quickly. I'm not going to get into all the details. The second largest U.S. automaker, we're talking about Ford, would be far worse off without its Ford Motor Credit Co. unit, which is effectively funding turnaround efforts by routinely borrowing in the debt markets and paying a dividend back to the parent company. This is unbelievable what they're able to do. Are you able to do this? Are you as an individual able to take advantage of all these little different things that the corporations can? No, of course not. But people don't know what's going on. They're saying, hey, they're bringing the jobs back. The jobs are fantastic and so on and so forth. They have every excuse in the book. Like, you as the individual always get slammed. The middle class is evaporating and they think that their 401k is going to help them ride to the moon. I've got really a whole different set of information on that, but we'll get into that another time. All credit to Ford Credit. Automakers Finance Company is making up a growing amount of profit. And you could see what's been happening. This chart goes back 2016 up until nearly the end of 2019. You could see that there, pump it up. Ford Credit has boosted its contributions to Ford as automakers struggles. These companies are being hit hard, there's no doubt about it. Ford is just one example of that, but we see that in the auto industry in general. It's really taking a hit right now. Ford has found a way to make some profit using the central bank gift. That's right, cheap money. That's all for this video. If you found it informative, hit that thumbs up button. All you gotta do is click one button and you are supporting me. Thank you very much. If you want to learn how to sell on Amazon, how to understand what's going on in e-commerce, maybe you don't have no real desire to sell on there, but you just want to learn about it, check it out. It's free, theamazongps.com. If you want to know about the financial history, the education that was robbed from you out of the school system, I teach you everything in these two very simple books. Check them out at the link in the description. Audiobook is available at themoneygps.com. Wait a second, don't go anywhere. I know you're just about to click off. This video has so much data. You gotta watch it if you haven't already. Just click this button, it'll take you over there. I'll see you soon.